Thank you everyone for joining. We are hosting a webinar on self-directed IRAs, which is a very important topic. I think most of us know what an IRA is. It's an investment retirement account. It contains special tax provisions that encourage or incentivize you to sock away money for retirement. And there's self-directed IRAs, there's traditional IRAs, and then there's other variations of it as well. But a key thing about IRAs is that you don't have to put it in stocks. You can actually put it in private investments, such as Trophy Point, actually. And so the reason why you'd want to do that is because you could potentially earn returns that are outside or non-correlated with the general stock market. And if you've been following the markets, especially over the last couple of years, you've noticed that there's a lot of volatility and a lot of up and down when it comes to the general stock market. And investing in private investments for your IRA could be a great way to get away from the volatility. So anyway, if you don't know who I am, I love real estate. I enjoy the act of real estate. I enjoy the activity of finding investments. I think I would be in real estate no matter what time period we would be in, whether it's in the 70s or 80s, if I lived in that era. I just love the act of finding a building, financing it, getting people in that building, and then obviously drawing cash flow out of it. So I've got a lot of experience in hotels, multifamily, single family, self-storage. I've owned all those asset classes. It also makes me a great lender also on those asset classes as well. And so I teach real estate at Georgia State to master's and undergrad students. You're welcome to attend a class if you're in Atlanta on Monday evenings. Trophy Point's got we now got 55 million under management, not 45 million. But we've got a lot of deals under our belt. And then I am in the Army still, actually, in the reserves, which I enjoy as well. Here's our track record, a little about Trophy Point. If you don't know about us, we've lent out about 120 million over the last 3 years. We haven't had a single default. We haven't lost a single dollar on any of our loans. We've got a lot of repeat borrowers, and we've delivered 15 quarters of interest payments, and we've never missed an interest payment. And I think that's important because what we're going to be talking about today is stability and how to grow your retirement dollars. And Trophy Point represents an excellent way to do that. First and foremost, you are welcome to contact me anytime, whether you're an investor or not, or whether you don't invest. It doesn't matter. I love helping people with real estate problems. I enjoy ensuring that people don't lose money. Having lost money myself in other real estate deals, I know it sucks. And so I hope people can benefit from my experience. And Mike Martin, he put this on LinkedIn once, where he had called me up a few years ago. He wanted to run a small apartment deal that he was doing by me. And I asked him some pretty interesting questions based on what he was telling me. And it turned out, one of the questions I had him ask of his seller ended up saving him a lot of money. It turned out his seller had done repairs without getting proper permitting done. And Mike would have had to redo all that stuff and bring stuff back up to code, and would have cost hundreds of thousands of dollars and would have killed his deal, actually. And I'm glad that a simple question that I asked, prevented him from getting hosed on that particular deal. So regardless of whether you invest in Trophy Point or not, I enjoy teaching. I enjoy talking about real estate. So there's my number. There's a QR code. You're welcome to get on my calendar. Feel free to call me anytime. So private credit is the latest, probably the hottest asset class, believe it or not, on Wall Street and probably in the world, I would say, because interest rates have gone up. The banks are in trouble in terms of what they can lend on. The stock market, returns are not as high as people are projecting, or what they thought they were a few years ago for the current period of time. And so now with private credit, private lending, which is what Trophy Point does, you can now get solid equity-like returns, 10% plus returns for investing without the risk and without the volatility. And that's amazing. I think from a risk-adjusted standpoint, that's what we all want, is higher returns without the ups and downs, without the risk. And so Trophy Point exists to do precisely that. And I'm the largest investor actually in the fund. And Trophy Point was originally set up to house my money, actually, and lend out only my money originally. And then the request became larger, and so we decided to form a fund around it. And so if you don't know what we do, we're private lenders, also known as hard money lenders. We lend on senior position liens on commercial real estate, really single family and multifamily real estate. We focus on lending to military affiliated people, which actually helps keep our defaults to non-existent rates. We offer our investors 8 to 12%. We have $6 million personally invested. I have $5 million of my own money invested, actually, and I take the first loss on any bad decision or bad deal that I do. So I try to align risk as much as possible with investors. I'm I'm a firm believer in not slinging money out there without consequences. And so I enforce that first loss provision, not only amongst myself, but also my two other partners who are co-invested with me as well. And I think it shows up in our zero default and no loss rate with our borrowers. So if you didn't know, like I said before, private lending can get you 8 to 12%. It's right up there with the stock market, and it's better than most other asset classes that you could potentially invest in as well. But in 2022, the stock market dropped 22%. Trophy Point did not. And in fact, I'm proud to say that our 10% and our 12% share classes were able to outpace and beat the market on an annualized basis for the last 3 years. The S&P returned 9.88% with dividends reinvested, and our 10%, 12% guys obviously beat that. And if you reinvested your interest in Trophy Point, which you will do if you invest in a self-directed IRA, then the yield actually comes out to 10.3 and 12.3% in terms of a yield. So this is what Trophy Point offers for our retirement accounts. Minimum investment is $25,000, and it carries with it a 10% rate. And so we do that because we like our IRA investor dollars. And selfishly speaking, if you invest via self-directed IRA, the likelihood of you redeeming your money from our fund is lower. And so we offer a higher interest yield in exchange for investing via a self-directed IRA. And so if you wanted to learn more, you're always welcome to use the QR code at the bottom of almost every slide, and feel free to book a time with me. So let's get right to it. So I'm really excited to invite Scott Maurer to chat with us. He's the Vice President of Sales at Advanta. And what I also appreciate about Scott is that he's been with Advanta for a long time, but he's also an attorney. And I think having a sales guy that has legal experience is a fantastic person to listen to, because I don't think Scott's going to say something out of turn that an attorney would not say. And as we all know, attorneys are more conservative in nature in the manner in which they speak and say things and make representations. But we have chosen Advanta IRA as a preferred IRA partner. And the reason why we do that is because we know it is a bit of a hassle on occasion to onboard or transfer, let's say, your IRA dollars from Fidelity or Vanguard into a self-directed custodian. And so what we like about Advanta is the ability to pick up the phone, call Scott or one of his associates, and actually talk to somebody through the process and get everything set up. We've done several investors through Advanta. We like the process. We like how they operate. They speak plainly. They explain things very clearly. We're happy to partner with Advanta in that regard. And we're not paying each other or anything like that for this presentation. We just thought it'd be a good webinar to have, because I think being able to grow your retirement dollars 10 to 12% year over year, and if you do that over 20 years, you'll take 100 grand and turn that into 1.2, 1.3 million just by sitting back. So that being said, Scott, thanks so much for joining us. We appreciate you joining us today, and I'm gonna hand it over to you.
Yeah, good, great, Gaysor. Thanks for having me on. Thanks everyone for attending tonight. I really appreciate giving the opportunity to speak and share information. I think one of the things you said that we really do focus on, I really believe in, is making the process easy. Presentation we'll go today has some some industry lingo. We do try to make it as simple to understand as possible. It is not a difficult process to self-direct your IRA account. That's one thing I want to make sure it's clear. People think it's something different, it's something new, therefore it must be complicated, it must be difficult. There are some hiccups here and there that we run into, but we usually can identify those up front. The biggest hiccup that will occur, we'll talk a little bit about it tonight, is transferring or rolling over money from your other custodian. That's where you're going to see issues pop up every now and then. But if we know who you're moving money from and what type of an account you're coming from, we can kind of dodge those issues a lot of times at the outset. My contact information is here on this slide. Always, as Samir said, I love to help educate and talk to people as well. If you have other just basic IRA questions that have nothing really necessarily to do with self-direction, and you're just concerned, what's an RMD? How does that get calculated? What are the contribution limits for my IRAs? Please reach out to me. Always happy to help educate as well. Talk about investing with a self-directed IRA account tonight. and really go over some of the basics, but really focus a little bit more so on the private lending and aspect of those particular accounts. So just a little bit of background on our company. We've been around for almost 20 years. As Samir noted, I've been with the company over 18 now. Of those almost 20 years, I knew very little about self-directed IRAs when I started. I kind of just followed our owner at the time around and listened to his presentations and picked up a lot of the information as we went along. The neat thing to me, I still learn new things every so often. I used to say every day, but it's as time goes on, less and less. So you hear a lot of questions over and over again, but always learning, and we try to keep our clients up to date as well. So we held currently over $2.7 billion in assets under management. We have over 11,000 active clients. Again, we're really committed to two things: the education. I mean, we love to get out and speak, whether it's myself or a colleague. Doing a presentation such as the one we have tonight, or if it's simply talking to people one-on-one. And that's certainly what I would invite anyone listening to tonight who has a question to reach out to me. We're going to talk in generalities tonight, but if you have specific questions as it relates to your retirement situation that you either don't want to ask in the chat, you can certainly contact me. We'll go through those individually. So we're very big believers in education, and also, like I said, as Samir mentioned, that customer service experience. As I said, this is new. Self-directed IRAs, a lot of times when we talk to someone, this is their first time doing a self-directed IRA. It also could be their first time investing in an alternative asset like Trophy Point. So we're kind of helping walk you through that process, and that's really where our customer service experience comes into play.
And Scott, I got an offline question already, actually.
Sure.
The question from Tanya is, how are self-directed IRAs governed, or how is Advanta governed? Like who oversees the assets that you have in custody?
That's a great question. So currently, Advanta, we are a self-directed IRA administrator. We have a custodian, and that company's name is Mainstar Trust. Now, we are in the process of becoming our own trust company. We will have that in place by the end of the year. But currently, Mainstar Trust acts as our custodian. All of the interface the clients have is through us, so you're not going to have any interaction with Mainstar. Mainstar is a non-depository trust institution. They're based in the state of Kansas, and they are subject to Kansas state banking regulators. So they are audited on a regular basis by the state of Kansas. They in turn audit us on a daily basis for our balances and our accounts. So the backup is, the state of Kansas banking regulators are making sure that we're doing what we're supposed to do. Now, when it comes to self-directed investments, one thing I like to mention, though, is the fact that we don't do due diligence on investments. So when it comes to making an investment, any protections you may be offered for your investment, you're going to have to kind of discover those somewhat on your own. For some people that buy real estate in their IRA, they may have property insurance helping protect that asset against loss. For other investments, you need to make sure you have your proper ducks in a row. But we, again, are governed by Mainstar Trust as a custodian. We also maintain errors and omissions and fidelity bonds insurance as well, up to $2 or $3 million per account, also for protections for any wrongdoing. So we have our bases covered there, but always welcome that question. It's a great question to ask, I think, when you're dealing with different custodians.
Thanks.
Yep. So I'm not sure how many people on the call have heard about self-directed IRA before. We are hoping that the word is getting out more and more, but most individuals have not heard about self-directed IRAs because their 401k, their IRA account, is with a bank. It's with a brokerage firm. Samir mentioned Vanguard or Fidelity. There are certainly countless others as well. The common thread with those custodians is they only offer you really publicly traded securities as the investment inside of your portfolio. So can choose from a variety of stocks, bonds, or mutual funds, but IRS regulations allow you to invest in a much broader range of investments inside of your IRA account. So you have other choices. The key thing, though, is finding a custodian who will allow you to invest in assets all of the assets the IRS allows, rather than limiting you simply to those assets that they control. And that's really, like I said, the brokerage firms, they're letting you buy stocks and mutual funds. They are not going to advertise that you could invest in private lending through your IRA account because it's not something that they do. So IRS regulations allow for a broad range, but they don't require every custodian to hold every possible investment. So here's just a couple of examples of alternative assets. A lot of different real estate investments. Probably 70 to 75%, maybe a little bit more, are the assets we hold under management are real estate in nature. And that could be anything from a rental property to a rehab, to a mortgage loan, to tax liens and tax deeds, to, to various types of private lending assets. So this is not an exhaustive list of all the assets you can hold in your IRA. There's just simply this, probably the most common assets that we see that we hold on behalf of our clients at Advanta IRA. And the thing that all of these assets have in common is that your typical custodians, the Vanguards, the Fidelities of the world, will not hold these assets on their platform. So that's why companies like ourselves exist, because all of these types of assets are available to you if you have a custodian who's willing to hold it. Again, that's the role that we serve at Advanta, are to hold these truly alternative assets that you go and find and you decide that you want to invest in. Our job is going to be to make sure that we manage the process from opening the account to making your investment, and also managing the investment to keep your IRA, keep your funds tax protected. Again, kind of cycling back a little bit to the last slide, brokerage firms, I've had many clients over the years say, hey, I'd talk to my broker, I talked to my advisor, I mentioned wanting to invest in a private lending deal, for example, and they told me I was going to have to take the money out of the IRA and pay taxes on it, and then I could use the money for what I want. And then the reality is you don't. And that's the key distinction with a self-directed IRA allows you to do, is make these investments inside of the IRA umbrella, keeping all of your money completely tax-free when you're making the investment, and then certainly all of the income that's being generated also going back into your IRA tax-free or tax-deferred. Yep,
I know a few of the people on the call actually work in agriculture. I was really curious to see farm animals. I never
yeah,
thought you could take
I
time
wouldn't have thought it either, but this was something I think probably early on in my career at Advanta, we had someone who wanted to invest in an alpaca because their wool is, I guess, hypoallergenic or something like that. I'm probably getting that wrong, but they wanted to invest in an alpaca. It wasn't an alpaca they were going to keep on their property or keep as a pet. It was an investment they made inside their IRA account and buying an alpaca. And I think it was either when shedding season came, and then they realized their profits then, or maybe it was mating season, and it was the birth of a new alpaca. But yeah, that was an investment someone made in their account.
Wow. Huh. Cool. That's really cool.
And I've heard of people investing in, you can invest in, racehorses as well inside of your IRA. So,
but I do want to emphasize, like, the one thing you mentioned at the beginning is that you as the investor, you need to perform your own due diligence on any of these particular investments. It is private. You can use retirement dollars for it, but like you as the investor need to perform your own due diligence, like you would on anything else, I guess.
yeah. And so over the years, I mean, like I said, I've been doing this for 18 years and I've met a lot of people. And I think most people, their decision to self-direct and go down this path comes from one of three buckets or three reasons, and maybe two or three of these all together. But for some clients, it's simply, this is a new source of capital for them. They've come across an investment opportunity that they don't want to miss out on. Hey, I can get 10 or 12% of my money. That's something I would like to take advantage of, or more, or whatever the case may be, or it's a startup company that you wanted to get involved in. And the IRA is providing you with that source of capital. You have personal savings funds that maybe you use for an emergency or for a rainy day or a medical emergency, things like that you don't want to touch. And your IRA and your 401k is then giving you that money to say, hey, there's an investment opportunity. I don't want to miss out on it. And here's the way I can not miss out on it and also keep my personal savings money intact. I can use my IRA, I can use my 401k as that capital for that investment. Or as well, people who already are investing, in private loans or in real estate. Again, just, hey, I can grab more deals and invest in different ways using my IRA and 401k. For a lot of our clients, there's the fatigue of the stock market, the ups and downs. I know, Samir, you showed that chart that the market historically returns 10 or 12%. I actually sat through a presentation a couple of years ago now where someone was saying similar things. Hey, the stock market averages that 8 to 10 or 12% a year, but historically only 1/3 of the years the stock market has been in existence has the actual rate of return that year been between that 8 or 10%. Other than that, it's either a lot higher or a lot lower. And depending on when you're entering and exiting the market, That's the tough thing. So some people just tired and unsure of those types of investments, looking for alternatives. And again, some people, it's just, hey, let's just diversify, right? I have some money in the stock market. That's great, but I don't want all of my eggs in one basket. And I have other opportunities and other alternative assets where I can put some of this money that's not tied to that particular market.
Cool. Scott, we have two questions actually. The first one probably goes back to your other slide. So I'll go back. Andrew asks, LLCs, can we elaborate on what it entails to invest in an LLC? And you probably want to talk about some of the restrictions around investing in an LLC or a company.
Yes. Yeah. So with LLC, so an LLC is a limited liability company, and a lot of people are familiar with those, and all states allow for those, and those are very diverse entities in themselves. So you could invest in an LLC that's somebody else's LLC, like where they're starting up a company, or it's a private lending fund or something like that is structured as an LLC, and you are just one of many investors, kind of as a passive investor. Perfectly fine to do that. We've also seen individuals who want to obtain what they call checkbook control with their IRA, where they get more direct control of their funds rather than having Advanta issue a check for each investment or have us receive payments into their account or pay expenses out of their account. They could set up an LLC just for their IRA account as kind of to run its own entity. So that's a couple different ways you can do that. Like you said, Samir, though, you want to be careful. LLCs, like, like say your personal business, hey, I'm a consultant. Maybe I have my own private business and it's structured as an LLC. Your IRA cannot invest in those types of structures where you or certain disqualified persons are actually running the LLC or being paid as the actual president or manager of that particular entity. So I've seen people invest, 3 friends get together and form an LLC to buy a piece of real estate. And so your IRA is owning 1/3 of that LLC. So there's a lot of different ways you can structure that investment.
Thanks.
All right. So when it gets into account types and what monies, you're sitting there saying, okay, I'm listening to you talk about self-directed IRAs, but exactly what does that mean? And I think a great thing to point out is that the words self-directed are really more of a marketing term and a moniker really that describes what you're able to do with the money inside of your IRA. A self-directed IRA still at its core is going to be either a traditional IRA or a Roth IRA or maybe a SEP or a simple if you're self-employed. So the contribution rules for IRAs, the distribution rules, they are all exactly the same with a self-directed account. The difference is what you are choosing to invest your funds into. That's where the self-directed term comes into play. But again, we have clients who have self-directed traditional IRAs or self-directed Roth IRAs, where again, the difference may just be in the tax treatment of the contributions and the distribution. So really any type of IRA can be self-directed. We also have solo 401k plans for people who are self-employed. You can invest in one of those types of plans. We have health savings and education savings, which are not retirement accounts, but they follow some of the same rules that are involved. And then the other big bucket of funds, I think, where people have money that they could invest that they might be forgotten about or neglected are former employer plans. People who have money in, that old 401k. You worked for a company for a number of years, you contributed to your plan there, but then you left, right? You either quit, you retired, maybe you got laid off, and you moved to a new job, and you forgot about that old plan. Those former employer plans can also be used to self-direct. So whether it's a 401k, a 403b if you're a former school teacher or school employee, TSP plans for former military. Those are great, those thrift savings plans. Those monies can also be rolled over into a self-directed IRA and used to make some of the investments we're talking about tonight. The only type of retirement plan where you're going to see a restriction is an employer's plan, like a 401k with a current employer. As long as you're currently employed, they can restrict your ability to move some of those funds. So that's something you'd have to check with that individual employer. But again, any type of IRA qualifies. Any former employer plan qualifies as well.
Question from Panil. He asks, are education savings accounts the same thing as the 529 plan?
They're not. That's a great question. So 529 plans are education accounts done typically through each state. Each state allows for certain 529 plans. And in Florida, we call it the Florida Prepaid College. Some of them, they have different investment accounts, but 529s are state-run entities. And through those 529 plans, you generally are limited to the investments they have there. An education savings account is also known as a Coverdell or Coverdell ESA account, where you can contribute $2,000 a year to that account and then invest it however you wish. It works a lot like a Roth IRA account as far as that goes, but the education savings account is not tied to any particular state. So any monies placed in that grow within an ESA can be used in any state. Now, 529s, typically you're going to be limited to using those funds within that particular state where that 529 plan is established.
Oh, got it. And what about pension plans? If someone, let's say, they're a former teacher, they work for TIAA-CREF, which is a big, teacher pension plan, can they direct those dollars into a self-directed plan?
They can, yeah. So a pension plan is just another type of a former employer plan. So 401ks, I won't go into too much deep, but 401ks are defined contribution plans where you dictate how much money is going in, and it's up to you to grow the money. Pension plans are what they call defined benefit plans, where you work for, say, like I said, we work for the school system, and they say, hey, when you retire, you're going to receive X number of dollars per month based on your years of service. Once you leave, you can, if you wish, forego the defined benefit at the end of the day, take a lump sum and then invest it on your own and potentially grow it to much more than you would have if you simply left it in the defined benefit plan and took your monthly stipend, when you hit retirement age.
Wow.
Great question. One thing I don't have on here, I don't know who's in our audience. The other kinds of accounts that we can do, if you are a sole proprietor and you have your own 401k, for your small business, you have your own, your doctor, you have your own small pension plan. We do have a mechanism where we can also record keep and hold alternative assets in those types of plans as well. So just to kind of keep that in mind, if you are somebody who, hey, I have my own, my small law office or my small dental practice, and I have a little 401k plan for me and my employees, there is a way for you to you as a trustee to hold alternative assets underneath that plan, and we can help with that too. So again, getting back to the people listening, you looking at that last slide and say, hey, I have one of those accounts. I have an old 401k or have an IRA. I want to self-direct. What does that look like? How does it work? In order to keep your money tax protected, you can move funds either by doing a transfer, which is moving money from one IRA to another, or moving money via direct rollover when you do have that former employer's plan, like the old 401k, 403b plan. So if you have money in an IRA at a brokerage firm, again, you talk to your advisor and say, hey, if you're going to take money from your IRA and invest in this piece of real estate or this private loan, you're going to be hit with taxes, you're going to hit with penalties. What they don't understand is that you're not pulling money out of your IRA, which would be taxable if you take personal possession of it, but instead you are doing a transfer or a direct rollover where the money is moving from one custodian to the other. It's not touching your hands. And you're just simply moving it into a different type of IRA that will allow you to take advantage of these types of alternative assets inside of the IRA itself. So a transfer is simply industry-specific term for going from one IRA to another IRA, and a direct rollover is moving from an old employer's plan to an IRA account. The process is a little bit different depending on which way you're going, and we help you manage that again and tell you what steps you need to take. And again, the important thing is both transfers and direct rollovers are non-taxable events. There is no tax consequence as long as the money doesn't touch your hands or go into your own account. And that process for transfer rollover can take anywhere from a few days, potentially a few weeks, depending on who your other custodian and how quickly they work. So you've set up the account, you're getting your money transferred and rolled over. Now it's putting that money to work, right? You're not moving the money to the self-directed IRA to have it sit in cash. You're wanting to put that into an alternative asset. And so here's a little case study to demonstrate a little bit what this process is going to look like. So in this case study, it's a private lending deal where Lisa has money inside her Roth IRA, looking for a better rate of return than she's getting in that stock market. And she decides, hey, I'm going to lend money from my Roth to a third party. Basically on a promissory note. The third party is going to sign a note saying, I promise to pay to your Roth IRA account X number of dollars. I'm going to pay you X amount of interest, and I'm going to make monthly payments back into your account. and we're going to agree on a maturity date for that investment as well. Again, we in Advanta, we are not going to be involved in doing due diligence on the borrower. We're not going to get between Lisa and her borrower as far as the terms that they have agreed to. That is between you as the IRA owner and the person that you're lending money to come to that agreement. Again, this is money going from her Roth IRA to the third party. It is an investment. So the money leaves the account. Same principle involved as you taking cash in your Roth IRA now and buying Amazon stock. In this case, you're just buying a private note to this third party with this promissory note. In Advanta, even though I am an attorney, I do not draft any legal documents. So you would have to make sure that you have appropriate parties helping you out with that. But again, the terms of the note dictate that, hey, she's going to get monthly payments of a little over $400 for the next 3 years, all coming back into her Roth IRA completely tax-free.
Yeah, and real quick, this is if you invested in Trophy Point, it would look almost exactly like this. Trophy Point would issue a promissory note. We do actually pay 10%. We pay quarterly though, or we have the option to reinvest your interest, so your interest earns interest.
Yep, and then Samir, that's a great point, because again, when it comes down to, and that's why I've always thought private lending is so attractive when you do it, is it comes down to kind of that, what the different terms that you can, hey, I don't need monthly payments, just pay me quarterly, or don't pay me at all. Let's roll this money back into the note and let's have it compound a little bit. Those types of terms are between you and your borrower.
Yep. We have one question actually from Valerie. She says, for those of us that are old, how do RMDs work when invested in real estate, and how can I convert my traditional IRA funds to Roth when invested in real estate? So
great, couple questions there. I'll take a little explaining, make sure everybody else that's listening on the same page when we talk about things. So we'll take the first question, the RMD, or what's called a required minimum distribution. Currently, with a traditional IRA and any taxable IRAs, so your traditional IRAs, your SEPs, your 401ks, you are required to take a minimum amount out of the account starting at age 73, and that age increases to 75, I think, by 2033. But starting at age 73, you're required to take a minimum distribution of funds out of your account. So the money in your IRA has not been taxed since you put it in. It's been growing tax deferred. At age 73, the IRS and the government says, hey, you got to start pulling money out and start paying some taxes on those funds. So that's when the required distribution kicks in. That's typically your first year is about 3, maybe 4% of your total balance you have to withdraw from all of your taxable accounts. So when it's time to figure out your RMD, you add up the value of all of your taxable IRAs and 401ks, you divide it by your life expectancy number at that time, and you get, let's say you have a $100,000 account, so now you have to take out $3,000 or $4,000 from your IRA accounts. Now you can take that money from any account that you wish. You do not have to pull out money from each individual IRA. You just have to satisfy the total RMD amount from one account or the other. So in this particular instance, if Lisa was, if she had a taxable IRA, number one, she has a traditional, and she was over age 73, with a $50,000 account, if that's all she has, she's going to have to take out a certain amount of cash each year from that particular IRA to meet that required distribution. If you are of RMD age, you probably don't want to put all of your funds into a completely illiquid investment, because you are going to want to distribute some cash from that investment to satisfy the RMD. So that's something to consider going into the investment. Now, the other question, I think, Samir, was relating to moving the traditional funds to a Roth.
Right. I think she has to convert from traditional to Roth and pay the tax when she does that conversion.
Correct. Yeah. Traditional to Roth conversion is simply taking the money in your taxable IRA or your traditional IRA, moving it into a Roth so that that money is now growing completely tax-free. When you do that, you move money from the traditional to the Roth, you pay taxes that year on the amount of cash or assets that move from the traditional to the Roth. Going forward, it's earning money tax-free, and RMDs do not apply to Roth accounts. So that is a discussion to have with your CPA to figure out what you would be looking at if you did a conversion from a traditional to Roth. What is your tax bill going to look like that year for doing that conversion? That's something that, unfortunately, we cannot assist with.
Right. And then the third part of Valerie's question was, how do RMDs work when real estate is involved? And I think you answered it, that you just have to make sure that you don't invest in something so illiquid that you can't get money out when you turn 73 or older to not satisfy the 3 to 4% minimum distribution requirement.
Correct. You'd want some cash flow coming back into your IRA to satisfy that, or alternatively, you have other IRA accounts, say with a brokerage firm or a Vanguard, where you can satisfy your RMD from that. In fact, that's what most of our clients have. They have their IRA with us. They have their IRA at Vanguard. It's easier a lot of times to take their RMD from that account, that other brokerage account.
Yeah. Valerie, I hope that answers the questions, but good questions.
Yep. So in our example, we have Lisa looking to lend money from her IRA. So, Lisa, when going through the investment process, again, at Advanta, we are not going to evaluate the note. We are not evaluating the borrower for suitability for Lisa. But what we are going to do is make sure that the investment documents are properly titled in the name of her Roth IRA account. So this is a very important part of the process. When Lisa's making this investment and cash is leaving her IRA to go to this borrower, we need to make sure that that promissory note shows that the lender's name is Advanta IRA for benefit of Lisa Smith's Roth IRA account. The IRS looks at this investment in her Roth and they see $50,000 leaving the account. We have paperwork to demonstrate that this is an investment in her account, so therefore this was not a distribution out of the IRA. And more importantly, the income, the $15,000 of interest she's getting back in those 3 years, that is all coming back to her Roth. It is tax-free income to the Roth. It is not income to Lisa. So that's the important part of the process that we are going to manage, that we are going to make sure is that all the documents are properly titled. We will not send money out of Lisa's account until she has reviewed and approved all of the paperwork. She's going to review the note. She's going to sign off on it. Yes, I want to do this. We make the investment on her behalf. We send the cash out of her IRA, and then going forward, her borrower will be making those payments, sending the cash right back into her Roth IRA. When that note matures, the principal comes back into her IRA, or like I said, Samir, if you want, if it's the investor, if your borrower allows for it, you could roll your $50,000 into another note, into another term. That's completely up to you as the client to direct us what you want to do with your funds. Again, our job is making sure that the documents are titled properly and that the income comes back and is deposited to your IRA account. Just some things to make sure that you understand with self-directed IRAs. There are a couple of prohibited transactions and disqualified persons that you cannot deal with. So we had a list earlier on of all the different real estate and other types of investments that we see. The only prohibited investments in an IRA account, you cannot invest in life insurance, and you cannot invest in things that are deemed to be a collectible, like artwork or coins, vintage automobiles, things like that. Those are the only two prohibited investment classes for IRAs and 401ks. You also, though, cannot use your IRA to transact or invest with yourself and certain family members. There are certain disqualified persons, basically you and a spouse, and then directly up and down your tree, your family tree, your parents and grandparents, your kids and grandkids. All of those individuals are disqualified from investing or transacting really with your IRA. So using that last example of Lisa, she could not lend money from her Roth IRA to herself or to anyone who's considered to be a disqualified person. If Lisa wanted to buy a real estate, she can't buy a property that she intends to live in or lease out to certain disqualified persons. So there are some restrictions, again, with life insurance and collectibles and the self-dealing. And we've mentioned a couple times already, again, the due diligence. When you are making an investment with a self-directed IRA, you as the account holder needs to do your due diligence on the investment provider, anything other information that you need to make that decision to invest. That is up to you. It's not going to be up to Advanta to say, hey, you shouldn't do this, or maybe you should look into this. Maybe you should run a credit check. But that is going to be up to you to perform all of that due diligence. We're going to make sure, though, simply that the assets are titled properly. And, monitoring your account. We definitely will receive and deposit all payments back into your IRA. You'll get an email notification that the money came in. But you need to track and make sure that those payments are being made. So we do not send an email that says you have not been paid this month. So it is up to you to make sure you track and check that you're getting payments on time, or if you're investing in something like a rental property, you're going to have expenses being paid out of the IRA. And that's up to you to make sure that you're telling us to pay those expenses as well. So again, just a couple of important considerations. But again, the process is not difficult. It's very easy and simple to do. Here's a little chart kind of showing you the steps. First step, when you're ready to start self-directing, open up your self-directed account, right? Fill out our paperwork. It takes probably 15 minutes or less to actually get the paperwork completed. Again, myself or someone on my team will walk you through that. The next step is funding the account. So as part of the initial account opening process, we'll help you identify where your funds are at that you want to self-direct, and then whether that's going to be a transfer or a rollover, and what paperwork is going to be required for that. If it's an IRA account, you're going to fill out a transfer form that we submit on your behalf and to your other custodian. If it is an old 401k, you're going to have to reach out to them to start that process. And funding the account can take anywhere from a few days to a few weeks. It just depends on who your other custodian is and what type of an account you have. But again, we will help you identify up front where your money's at and what that kind of process looks like. Once you've opened the account, you're getting it funded, now you're locating the investment, and maybe you've already located the investment before you open the account with us. You decided to invest with Samir or some other private lending opportunity. Hey, I want to use my IRA to do it. You're going to select the investment. You're going to direct us to purchase this asset. And we are then going to work with your account manager. We'll work with the investment provider to make sure that all the documents show your IRA as the owner. Your IRA is its own separate legal entity. And so that's why that wording needs to appear on that particular paperwork. Once the documents have been properly vested, we send all the documents to you to review and approve. And ultimately, we then sign on behalf of your IRA if needed and wire money out of your IRA to that provider. Going forward, again, the gains of profits simply come back into your IRA. We receive and deposit and track those into your account. It can seem like an arduous process at first, I think, for people who've never done it before. It just takes a little bit of time. Like I said, sometimes it can take between a week and maybe 2 or 3, depending on your other custodian. But again, we're going to walk you through each step of the process, whether it's myself helping you get the account set up or ultimately your account manager that walks you through the investment paperwork. We're not going to send any money out of your account, complete a transaction until you have reviewed and approved all of that investment paperwork. The common questions we get asked, and sometimes I guess is the cost involved. And I know, Samir, you wanted me to share a little bit about that. We don't, we're not an advisor, so we're not charging an advisory fee. We're not selling products, so we're not charging a commission for what we do. We are simply providing an administrative and record-keeping service, and we charge flat fees basically for our service. It's essentially $50 account opening fee. That's getting your account established, requesting your transfer, or helping you with the rollover. When you go to make your investment, there's a $95 fee to make sure that those investment documents are all properly drafted and approved. So again, looking over the promissory note, the mortgage, if it's real estate, looking over the contract and the closing documents, the $95 fee again to make sure all the documents are properly drafted. And again, making sure we get your approval on that part of the purchase. And then going forward, once we've sent the money out of your account, we charge a flat $295 a year for record keeping your account, holding the asset, doing the IRS reporting, receiving the income. That is all included in that flat $295 a year fee. And that fee is the same whether you're investing $25,000 or $250,000 or more. That's the one asset of your account is that loan. The same work is involved regardless of the dollar amount. So that's our flat fee. You're not going to see any additional fees for, hey, we got a payment into your account, so we dinged you for receiving that check, or we're charging a percentage of your receipts. It is simply that flat $295 a year fee. And again, that includes all of the IRS reporting. The only other fees we have are just wire fees. If you're wiring money in or out of the account, just like you would have with any other bank, we charge incoming and outgoing wire fees. It's flat fees. They're right up front. It is not a percentage of the earnings. It's not commissions. It's not an advisory fee because we are not advisors. We are simply record keepers and administrators, making sure that your investments that you're telling us to do are properly titled and properly vested, and make sure you've approved of them as well.
This is great. And I'll say this, that I think their fees, Scott didn't ask me to say this, but I will say this. We've worked with a lot of self-directed IRA companies and custodians, like probably a dozen at this point. Trophy Point has about 170 investors, and we have about 5 to 8 million of self-directed dollars. So we've worked with a lot of custodians, and I think Advanta's approach and fee structure is mostly reasonable. And I'll give a gripe to Scott in a second. But we have a question. This is from James. Is it a static amount at the time of investment into Trophy Point, or as the IRA grows month by month, can that go into the investment? So I think what James is really saying is, if I put money into my IRA or into my IRA custodian, can I invest month by month into something like like Trophy Point. Like, let's say I start off with $50,000 and I want to put in $1,000 or $2,000 a month. How does that work? And I have my perspective on it, and then Scott, but I'll let you answer that first as it pertains to the
Sure.
fee.
Sure. So there's no restriction from an IRS perspective on doing that. You can certainly, the limitations you have on putting money into your IRA is that you can personally contribute only up to a certain dollar amount per year. So that's for right now for a traditional Roth, that's $7,000 or $8,000 depending on your age. So you could, in theory, put that money into the IRA and then direct us to add to that investment. Now, we do have a $50 additional capital contribution fee that we charge. If you were to say you have an investment of 50,000, the Trophy Point, you want to add another 5,000. We may have a $50 additional fee to add that extra cash there. The annual fee stays the same. That's not going to change. The other thing to consider, though, in theory, yes, you can do that. It also depends greatly upon the people that you're investing with. So if you're investing with a company that says, "Hey, we took in your $50,000 investment," we can't, or we're not necessarily willing, depending on the circumstances, to take in an extra $1,000 or $2,000 every month and keep changing some of the terms. That's going to be between you and the investment provider. So yeah, we're not going to. We would happily process it if you want to do it and the provider agrees to it. But that would be again between you and the provider.
And so there's a $50 investment purchase fee, right? So it drops from 95 to 50 each time you invest. Is that correct?
That's correct. Yes.
And then also there's another wire fee when that money is sent. Is that correct?
Correct. If we're sending it by wire, I mean, we can happily send checks or ACH transfers at no charge.
Oh, that's good
But
to
yeah,
know.
wire fee. Yeah, yeah. So yeah, we can send ACHs. I think up to $50,000 for ACH transfers without any charge.
Okay, that's great. Actually, I actually did not even realize that, because that's my gripe, is that people want to continually invest, and your record keeping fee is really reasonable, but then the other fees on a per transaction basis kind of add up. And so we recommend at Trophy Point, if you're an existing investor, to invest in $10,000 chunks, because then it makes sense from a absolute dollar or percentage basis, even with the purchase fees and the wire fees. And I'll say this, that it's not just Advanta. Every equity or every trust company does this, and the bigger ones actually charge a little bit more. So it's not completely unreasonable. But I will say,
And I will say this, and I'll say without committing necessarily specifically, we are always willing to hear and work with people depending as well on what you're looking to do. As long as it's, again, you're not sending $500 every 2 weeks and asking us to do that and say, can you waive the fee every time? That's still a lot of work there. But there are some things that we can do where the fees can be reduced or eliminated for additional capital contributions depending on how often you're doing it.
got it. The second question we got is, this is from Panil. Are fees per account type? So like, I think if you have multiple Roth IRA accounts, or one Roth IRA and one traditional, are they charged separately?
Yeah, for a tradition, if you're just say investing a traditional and a Roth IRA, we do typically waive the account opening fee for one of those because we already have your information in the system. We've already done everything we need to get accounts open, so we'll typically waive that fee. But the investment fee and the record keeping fee, we do charge that to each account, because when you're doing your traditional paperwork, that's a whole separate transaction from doing your Roth. And we are doing reporting on both accounts, and we are receiving deposit income into both accounts. You have to maintain separate accounts for the traditional and the Roth in order to do that. So if you do have different types of IRAs from that perspective, you could be looking at some of it, basically double the fees to some extent. Like I said, we'll waive the account opening fee. If you do have multiple traditional IRAs, though, or I'll make sure this is clear, if you have a few different traditional IRAs out there and you want to combine them, you can combine them into one traditional IRA with us. You do not have to keep that money separate. Every now and then I'll have somebody get confused that they have to open up multiple traditionals. When you don't, you can put all of your pre-tax money into one account. So if you have a traditional IRA and an old 401k that are sitting out there, that money can be combined into just one account with us. It's only when you're talking really pre-tax traditional funds versus post-tax Roth where you do have to have two separate accounts.
Got it. And I think that actually answers James's other question. A follow-on question is that he had a 401k that I think gets $23,000 a year of contribution. And he says for God, it would have to be converted to an IRA. So I think you could do that if you wanted to, James, or you could, if you had multiple accounts, you could also combine them into one. one as well.
Potentially, and if he's talking about contributions, it's like I said, IRAs are 7,000 or 8,000 a year. If you have your own, if you're involved in a 401k, you can contribute a good deal more as an employee, and if you have an employer as well, they might do a matching contribution. Just the different contributions for different types of accounts, and again, those are the types of things I'm happy to talk to someone offline about when you get into very more specifics with your situation and what you're looking to do.
Great. Well, thank you, Scott, so much. We're now in the formal Q&A period, but we actually knocked out about 15 questions while we were talking, so that's great.
Yeah, really. By the way, really good questions too. Those are right up. Those are good common questions that we get from a lot of people, and I'm glad that they were asked.
Yeah, and so if you have a question, please use the Q&A button or the chat feature. Either or, doesn't really matter, and we'll be here for the next few minutes to answer questions as well. I'm going to show everyone a chart, but like I said, if you're still listening, please feel free to use the chat button or the Q&A button to answer a question. Looks like we got a question. So I'm gonna actually open up my browser here, and I'm gonna type in compound calculator. You guys can still, Scott, you can still see my screen, right?
Yes. Yep.
So if you go to investor.gov, and I should have probably started with this in the beginning, but the reason why we're here. So let's just start with a smaller amount. So let's say your IRA has $25,000 into it, right? And you make no contributions to it. And you sit it for 20 years, right? Let's say you're 25 years old, you've saved up $25,000, and you let it grow for 25,000 at the trophy point rate, which is 10%, with no interest rate variance. And in trophy point, we actually compound quarterly. So I'll let you guess what $25,000 growing for 20 years at 10% interest, what that would be. If anyone wants to put a public guess out there, feel free to use the chat button. And I'll give you a second to let you guess what 25,000 will turn into in 20 years at 10%. All right, ready? Calculating. So $25,000, if you do nothing, and it grows at 10%, which is what Trophy Point can offer, will grow to $180,000 in 20 years, just for doing nothing. So if you're older, let's say you're 35 years old, and you invest $100,000 of your IRA, which is pretty reasonable for most folks, and then you leave it for 35 years, right? And so you hit the retirement age of 70, 75, when you probably need the money, growing at 10%, compounded quarterly, because our interest allows you to earn interest again, or your interest earns interest with each quarter. 100 grand compounded for 35 years at 10% turns into $3.1 million. So like you're done in many respects. Like for most people can retire, hopefully inflation comes under control, which we think it is. But for most people, investing 100 grand for 35 years at 10%, you're mostly done with your retirement goals. You definitely have a little more. You definitely will have more than the average American for sure. And that's the power of compounding, and that's the real essence of IRAs and self-directed IRAs, in my opinion. Private investments can give you the same level of returns without the volatility. And if you do it through your Roth IRA, especially, you can turn 100 grand into $3.1 million. That is why we're here, and that is why we offer that 10% rate, because we want to incentivize investors to stay in the fund. I don't think Trophy Point's going anywhere. After I sold my last business and cashed out quite a bit, I did not want to put my $5 million in the stock market and have it be subject to the volatility. I wanted it to grow at 10, 12% year over year. And so if you invest $250,000, and I'll finish here, and you grow at 12% annualized for 35 years, or let's just say 30 years, right? So you retire at 35-year-old at 250 grand. You retire in 30 years at 12%. Believe it or not, your 250 grand, just by earning 2 extra per points year over year for 30 years, you'll have $8.6 million. That's crazy. It's really crazy to me that you can start with a small amount like 250, which arguably most older people could have in their retirement. You get the 12% and you do it for 30 years, or even at any reasonable period of time. You can play with it yourself on investor.gov, and you'll have $8.6 million, which is more than enough for retirement. So anyway, I wanted to just stop that. I just wanted to show everyone that like that's the real reason why you'd want to invest in a self-directed IRA, earning a higher yield investment over time. Time is your friend. You want to invest in things where you can trust that the time length will play out over a long period of time. And that's what Trophy Point is. I mean, that's why I do it, because I'm, again, the single largest investor, and this is why we do what we do. So if there are no other questions for Scott or me, we'll end it tonight, right on time, right at 8 o'clock. So Scott's info is right there. Please, please hit him up. Please hit me up if you have any questions. I'm always a phone call or an email away. And that's it for tonight. So thank you, everybody, and I'll see you soon.
All right. Thank you, Samir.
Thanks.